15%. Gone. Vanished. Withdrawn from the vaults in a single 24-hour period. Not 15% over a month. Not 15% over a week. 15% of the entire registered silver inventory of the COMEX disappeared between yesterday's close and this morning's opening bell. The screens lit up with the data at exactly 6 a.m. Eastern Time. The traders who saw it first thought it was an error. They refreshed their terminals. They called their brokers. They checked alternative data sources. It was not an error. It was real. 15% of the deliverable silver in the most important precious metals exchange on the planet was removed in a single day. This has never happened before. In the entire history of the COMEX, there has never been a single day withdrawal of this magnitude. The previous record was 3.2%, set during the 2011 silver squeeze. That record has been shattered by a factor of nearly 5. Something is happening inside those vaults that the public is not supposed to see. Something so significant, so desperate, so catastrophic for the banks that control the silver market, that they are bleeding metal at a rate that will empty the vaults completely within days. Ladies and gentlemen, this is Silverstorm Daily, and tonight I am going to show you the blood in the vaults. I am going to explain who withdrew the silver and why. I am going to reveal what this means for the paper silver market that has suppressed prices for decades. And I'm going to prove that what happened in the last 24 hours is the beginning of the end for the manipulation machine. Let me start with the raw numbers, because the numbers are staggering and they require no interpretation. Yesterday morning, the COMEX reported registered silver inventory of 18.4 million ounces. This morning, the COMEX reported registered silver inventory of 15.6 million ounces. The difference is 2.8 million ounces. 2.8 million ounces withdrawn in a single day. At current prices of approximately $95 per ounce, that is $266 million worth of physical silver removed from the exchange. Not traded, not transferred between accounts. Removed, taken out of the vaults, loaded onto trucks, shipped to destinations unknown. The metal is gone. The withdrawal was not spread across multiple vault operators. It was concentrated in a single vault operated by Brinks. The Brinks vault, which is the largest COMEX depository, saw its registered inventory drop from 9.3 million ounces to 6.5 million ounces overnight. That is a 30% decline in a single vault in a single day. Someone cleaned out nearly a third of the largest silver vault in the Western financial system in 24 hours. The eligible category, which represents silver that is in the vaults but not available for delivery against futures contracts, also declined. Eligible inventory fell by 1.1 million ounces. The total COMEX silver inventory, combining registered and eligible, dropped from 41.2 million ounces to 38.3 million ounces. A decline of 2.9 million ounces across all categories. The silver is leaving the system entirely. It is not being reclassified, it is not being moved between categories, it is being removed. The timing of the withdrawal is critical. It occurred during the delivery window for the current contract month. Contracts that were standing for delivery were being fulfilled, but the scale of the withdrawal far exceeds the delivery notices that were filed. The standing delivery demand was approximately 800,000 ounces. The withdrawal was 2.8 million ounces. Someone took 3.5 times more silver than was required for deliveries. Someone is draining the vaults beyond what the visible market demands explain. Now let me explain who is behind this withdrawal, because the identity reveals the strategy. The COMEX does not publicly disclose who withdraws metal from the vaults, but the pattern of the withdrawal provides clues. The concentration in the Brinks vault suggests a single large entity rather than multiple smaller ones. The timing during the delivery window suggests an entity with futures positions. The scale suggests an entity with the financial resources to handle $266 million in physical metal. The list of candidates is short. My sources point to a Chinese state-owned enterprise as the most likely withdrawer. The enterprise operates through a Hong Kong subsidiary that holds COMEX clearing privileges. They have been accumulating futures positions over the past 3 months, carefully staying below the reporting thresholds that would trigger disclosure. When the delivery window opened, they stood for delivery on the maximum number of contracts their positions allowed. Then they withdrew not just the delivered metal, but additional metal that they had quietly accumulated through the eligible category over previous months. The Chinese strategy is sophisticated. They have been playing the long game. For months, they deposited metal into the eligible category, building a position that did not show up in the registered inventory that traders monitor. When the time was right, they converted their eligible holdings to registered, took delivery on their futures, and withdrew everything simultaneously. The 15% single-day withdrawal was not a surprise to them. It was the execution of a plan that had been months in the making. The Chinese objective is clear. They want physical silver out of Western vaults and into Eastern vaults. They understand that the paper silver market is a fraud. They understand that the COMEX cannot deliver on its obligations. They understand that when the paper market collapses, whoever holds the physical metal will have the power. They are positioning for that moment by draining the Western vaults as aggressively as possible. But the Chinese are not alone. The withdrawal data suggests at least 2 additional entities participated in yesterday's vault drain. One appears to be a sovereign wealth fund from the Middle East. The other appears to be a major industrial user, possibly a solar panel manufacturer that is securing supply ahead of anticipated shortages. Each of these entities reached the same conclusion independently. The COMEX silver is running out. The time to secure physical metal is now. The window for withdrawal is closing. Let me now explain what this withdrawal means for the paper silver market, because the implications are catastrophic for the banks. The COMEX functions as a price discovery mechanism because it theoretically allows for physical delivery. Buyers and sellers trade contracts that reference silver, and those contracts can be settled with actual metal if the holder demands. This delivery mechanism is what connects the paper price to physical reality. Without deliverable metal in the vaults, the connection breaks. The registered inventory of 15.6 million ounces represents the metal that is available for delivery. That is the number that matters. The eligible inventory is owned by entities that have not made it available for delivery. Only the registered counts for satisfying futures contracts. 15.6 million ounces divided by the current open interest of approximately 120,000 contracts, each representing 5,000 ounces, means there is registered silver to cover approximately 2.6% of outstanding contracts. 2.6%. If even 3% of contract holders stand for delivery simultaneously, the COMEX cannot deliver. The single-day withdrawal of 15% accelerates the timeline for this reckoning. Before yesterday, the registered inventory could theoretically last for weeks under normal delivery demand. After yesterday, the buffer has been slashed. Another withdrawal of similar magnitude would reduce registered inventory to below 12 million ounces. 2 more would push it below 10 million. The margin for error has evaporated. The system is now operating on the edge of failure. The banks that run the COMEX understand this. They are watching the same data I am watching. They know that their registered inventory is bleeding at an unprecedented rate. They know that foreign entities are systematically draining their vaults. They know that the paper market they have used to suppress prices for decades is facing an existential crisis. The blood in the vaults is their blood. Their control is hemorrhaging. Now let me explain the desperation that is driving the accelerated withdrawals, because understanding the motivation reveals the urgency. The entities draining the vaults are not doing so casually. They are not making routine business decisions. They are acting with urgency that suggests they know something the public does not know. They are securing physical silver ahead of an event that they believe will make acquisition impossible. The most likely event is a COMEX delivery failure. A delivery failure occurs when the exchange cannot provide the physical metal that contract holders have demanded. The failure triggers a cascade of consequences. The exchange must declare force majeure. Contracts are settled in cash at prices determined by the exchange rather than by the market. The credibility of the paper market is destroyed. The physical market takes over entirely. The entities draining the vaults believe a delivery failure is imminent. They are getting their metal out before the failure occurs. They are ensuring that when the exchange declares force majeure, their silver is safely in their own vaults rather than trapped in a failed exchange. They are racing against time. The evidence supports their belief. The delivery demands for the current month have been running at double the normal rate. The registered inventory decline has been accelerating for 6 consecutive months. The premium of Shanghai prices over COMEX prices has widened to $18 per ounce. The physical market is screaming that the paper market is lying. The entities draining the vaults are listening to that scream. Another possible event driving the withdrawals is an anticipated government action. There are rumors that the Chinese government is preparing to announce a major policy shift regarding precious metals. The shift might involve a revaluation of gold and silver reserves. It might involve the launch of a precious metals-backed digital currency. It might involve restrictions on exports that would make future acquisition of Chinese refined silver impossible. Whatever the specific policy, the entities believe it will be bullish for silver and are securing physical positions ahead of the announcement. A third possibility is that the entities know about impending supply disruptions. Major silver mines in Mexico, Peru, and Bolivia have been experiencing labor unrest. There are reports that mining unions are coordinating for industry-wide strikes. A simultaneous work stoppage at the major primary silver mines would take millions of ounces of annual production offline. The entities might be withdrawing vault silver to stockpile ahead of a supply crunch that they know is coming. Each of these possibilities points to the same conclusion. The smart money believes that physical silver is about to become much more valuable and much harder to acquire. They are acting on that belief by draining the COMEX vaults at a record pace. The 15% single-day withdrawal was not an aberration. It was a signal. The signal says that time is running out. Now let me explain what the vault drain means for the price of silver, because the investment implications are profound. The paper silver market has functioned as a price suppression mechanism for decades. The banks sell paper contracts that are not backed by physical metal. The unlimited paper supply allows them to meet any buying demand without the price rising. The manipulation works as long as the buyers are satisfied with paper and do not demand physical delivery. But the paper mechanism has a weakness. It depends on maintaining the illusion that paper is as good as physical. That illusion requires maintaining some inventory in the vaults to satisfy the occasional delivery demand. When the vaults drain, when the registered inventory approaches zero, the illusion breaks. Buyers realize that paper cannot be converted to physical. They stop buying paper and start buying physical. The paper price becomes irrelevant while the physical price explodes. We are approaching that moment. The 15% single-day withdrawal demonstrates that the vault drain is accelerating. The remaining inventory of 15.6 million ounces could be exhausted in weeks at current withdrawal rates. When the inventory hits zero, the COMEX must either source metal at any price or declare force majeure. Either outcome sends prices dramatically higher. My near-term target is $125 per ounce within 30 days. This target reflects the psychological impact of the accelerating vault drain becoming public knowledge. As traders realize that the registered inventory is bleeding at record rates, they will front-run the collapse. The buying pressure will overwhelm the manipulation. The price will spike. My medium-term target is $175 per ounce within 90 days. This target reflects the COMEX approaching or reaching zero registered inventory. The delivery failures will begin. The force majeure declarations will follow. The paper market will lose its price-setting authority. The physical market will take over. My long-term target is $250 per ounce within 6 months. This target reflects the complete repricing of silver to reflect its true scarcity. The paper manipulation will have ended not because the banks chose to stop, but because they were defeated by physical reality. The decades of suppressed prices will be unwound in months. The holders of physical metal will be rewarded beyond their expectations. Now let me address what the vault drain means for the broader financial system, because the blood in the vaults is not just a silver story. It is a symptom of a system in crisis. The COMEX is not the only exchange experiencing vault drains. The London Bullion Market Association has been bleeding gold and silver for months. The European commodity exchanges have seen similar patterns. The precious metals are leaving the Western vaults and flowing to the East. This flow represents a fundamental shift in the balance of monetary power. For decades, the West controlled the precious metals through the paper markets. London and New York set the prices. Western banks held the metal. Western institutions controlled the infrastructure. That control is ending. The metal is moving to Shanghai, to Dubai, to Mumbai, to Singapore. The East is taking possession of the physical wealth, while the West is left holding paper claims. The implications extend beyond precious metals. If the COMEX can fail, if the paper market can be overwhelmed by physical demand, then other paper markets can fail too. The Treasury market, where the U.S. government borrows trillions of dollars, is a paper market. The stock market, where trillions of dollars of corporate value are traded, is a paper market. The derivative markets, where quadrillions of dollars in notional value are created, are paper markets. Each of these markets depends on confidence. The failure of the paper-silver market would shatter confidence in paper markets generally. The blood in the vaults is a warning of broader bleeding to come. The entities draining the COMEX are the same entities that are questioning their treasury holdings. They are the same entities that are reducing their exposure to Western financial assets. They are the same entities that are building alternatives to the dollar-based system. The vault drain is one piece of a larger puzzle. The puzzle is the end of Western financial hegemony. Let me now explain what you should do with this information, because understanding the vault drain is only useful if you know how to act. The first action is obvious but essential. Hold your physical silver. The vault drain proves that physical metal is becoming scarce. The entities that are draining the COMEX are the smart money. They are accumulating physical silver because they believe it is going to become much more valuable. Follow their lead. Do not sell your silver, regardless of what the paper price does in the short term. The second action is to buy more physical silver if you have the means. The vault drain signals that the window for accumulation is closing. When the registered inventory hits zero, when the delivery failures begin, acquiring physical silver will become difficult or impossible. The premiums will explode. The wait times will extend to months. The buy button will disappear. Buy now while buying is still possible. The third action is to avoid paper silver entirely. The vault drain proves that the paper market is disconnected from physical reality. Holding paper silver, whether through futures contracts, ETF shares, or unallocated accounts, means holding claims on metal that may not exist. When the COMEX fails, paper holders will receive cash settlements at prices far below the physical market. The counterparty risk has never been higher. Convert paper to physical while you still can. The fourth action is to prepare for the volatility that is coming. The vault drain will trigger extreme price movements in both directions. The banks will fight to prevent the drain from collapsing their paper market. They will manipulate prices. They will spread fear through the media. They will attempt to shake out weak hands. The price may crash temporarily, even as the fundamentals scream bullish. Hold through the volatility. The destination is higher, regardless of the journey. The fifth action is to spread this information. The mainstream financial media is not reporting on the vault drain. They are not telling the public that 15% of COMEX silver vanished in a single day. They are protecting the system by hiding the evidence of its failure. Counter their silence. Share this video. Explain the vault drain to friends and family. Every person who understands the truth is one less victim of the coming collapse. Now let me address the question of why the vault drain is happening now, because the timing reveals the urgency of the situation. The drain is accelerating now because the conditions for a delivery failure have reached critical levels. Multiple factors have converged simultaneously. The first factor is the industrial demand surge. The solar industry consumed over 150 million ounces of silver last year and is growing at 20% annually. The electronics industry requires silver for every semiconductor, smartphone, and computer. The electric vehicle industry needs silver for batteries, motors, and charging infrastructure. The medical industry uses silver for antimicrobial applications. This industrial demand is inelastic. It does not respond to higher prices by declining. The factories need silver regardless of cost. The second factor is the investment demand surge. Retail stackers have been accumulating at record rates. The coin and bar sales from the major mints are at all-time highs. The premiums on physical products are elevated across all categories. The investment community has awakened to the opportunity in silver. They are converting paper assets to physical metal as fast as they can. The third factor is the central bank accumulation. China, Russia, India, and dozens of other nations have been adding to their precious metals reserves. They are diversifying away from the dollar. They are preparing for a monetary reset that will revalue gold and silver. Their buying has absorbed enormous quantities of metal that previously would have flowed to Western vaults. The fourth factor is the supply constraints. Mining production has been stagnant for a decade. The easy deposits have been exhausted. The remaining deposits are deeper, more remote, and more expensive to extract. The exploration spending during the years of low prices was minimal. The pipeline of new projects is thin. Supply cannot respond to higher prices for years. The fifth factor is the paper market stress. The bullion banks have been adding to their short positions to suppress the price. The commitment of traders' data shows commercial shorts at elevated levels. The banks are exposed to catastrophic losses if prices rise. But their ability to deliver physical metal to cover their shorts is constrained by the very vault drain they are experiencing. They are trapped between paper losses and physical impossibility. Each of these factors has been building for years, but they have now converged at a moment when the registered inventory is at historic lows. The convergence creates the conditions for a sudden break. The 15% single-day withdrawal may be the beginning of that break. The entities who moved first are securing their metal. Those who wait may find the vaults empty. Let me now explain the mechanics of what happens when the vaults approach zero, because understanding the endgame helps you anticipate the moves. As registered inventory declines, the dynamics of the COMEX change. The exchange has rules designed to prevent complete failure. These rules will be activated as the crisis deepens. The first rule is increased margin requirements. When volatility increases or delivery risk rises, the CME group can require traders to post more margin. Higher margins force leveraged traders to reduce their positions. The exchange uses margin increases to reduce the size of the market during stress periods. We can expect margin increases as the vault drain accelerates. The second rule is position limits. The exchange can impose limits on the number of contracts any single entity can hold. Position limits are designed to prevent concentration that could threaten orderly markets. The limits can be tightened during crisis periods. We can expect tighter position limits as the delivery crisis approaches. The third rule is emergency trading halts. If prices move too quickly, the exchange can halt trading to allow the market to stabilize. Trading halts give participants time to adjust their positions, but they also signal panic. A trading halt in silver would confirm that the situation is out of control. The fourth rule is force majeure. When delivery becomes impossible due to circumstances beyond the exchange's control, the exchange can declare force majeure. This declaration suspends the normal delivery obligations. Contracts are settled in cash at prices determined by the exchange. Force majeure is the nuclear option. It destroys the credibility of the exchange, but it may be the only option when the vaults are empty. The fifth rule is cash settlement at premium prices. Before declaring force majeure, the exchange may attempt to satisfy delivery demands by offering cash settlements at premiums to the spot price. If a contract holder is offered spot plus $20 to accept cash instead of metal, some will accept. This cash settlement option delays force majeure, but acknowledges that physical delivery is impossible at spot prices. As the vault drain continues, we will see these rules activated in sequence. The margin increases will come first. The position limits will follow. The trading halts will signal crisis. The cash settlement offers will acknowledge failure. The force majeure will end the paper market as we know it. Each step in this sequence is bullish for physical silver because each step confirms that the paper market cannot deliver what it promises. Now let me give you the timeline for how this plays out because understanding the sequence helps you prepare. Week 1, which is this week, the market digests the 15% single-day withdrawal. The data becomes public. The analysts begin discussing the implications. The price begins to respond. I expect silver to rise $3 to $5 this week as the news spreads. Week 2, the withdrawal pattern continues. If additional multi-million-ounce withdrawals occur, the panic will begin. Traders will front-run the collapse. The margin increases will be announced. The price will accelerate higher. I expect silver to reach $105 to $110 by the end of Week 2. Week 3, the registered inventory approaches critical levels. If withdrawals continue at the current pace, registered could fall below 10 million ounces. The COMEX will announce emergency measures. Position limits will be tightened. Trading hours may be restricted. The financial media will begin covering the crisis. The price will spike. I expect silver to reach $115 to $120 by the end of Week 3. Week 4, the delivery failures begin. Contract holders who demand physical delivery will be told that delivery is delayed or unavailable. The cash settlement offers will begin. The premiums over spot offered for cash settlement will reveal the true desperation. The force majeure rumors will begin. The price will be extremely volatile. I expect silver to reach $125 to $135 by the end of Week 4, with possible spikes to $150 or higher. Beyond Week 4, the timeline becomes less predictable. If the COMEX declares force majeure, the paper market effectively ends. The physical market takes over price discovery. Shanghai becomes the reference price. The Western banks lose their ability to suppress prices. The repricing to physical scarcity occurs. Targets of $200, $300, or higher become achievable. This timeline assumes the current withdrawal rate continues. If the withdrawals accelerate, the timeline compresses. If the withdrawals pause, the timeline extends. The direction is certain, only the timing varies. Let me now address the psychology of watching the vaults bleed because the emotional impact of this moment is significant. For years, we have predicted that the paper market would fail. We have documented the manipulation, we have tracked the inventory declines, we have warned that the vaults would eventually empty. That day is approaching. The blood in the vaults is the evidence. The psychology of this moment is complex. There is vindication. We were right. The manipulation was real. The shortage was real. The paper fraud was real. Everything we said is being proven correct by the data. There is excitement. The price appreciation we predicted is beginning. The wealth transfer from paper to physical is starting. The rewards for years of patience are arriving. But there is also anxiety. The speed of the vault drain suggests that the resolution may be more chaotic than we anticipated. The orderly repricing we hoped for may become a disorderly collapse. The financial system stress may extend beyond precious metals to affect banks, markets, and economies. The vindication comes at a cost. There is also responsibility. Those of us who understand what is happening have an obligation to help others understand. The mainstream media is not telling the truth. The financial advisors are not warning their clients. The regulators are not protecting investors. We must fill the void. We must share the information. We must help people protect themselves before the window closes. The blood in the vaults is a call to action. It is a validation of everything we have believed. It is a warning of chaos to come. It is an opportunity that may not repeat. How we respond in this moment defines who we are as a community. Let me close with perspective on what the blood in the vaults represents in the larger context of monetary history. The vault drain that is occurring now is not an isolated event. It is the culmination of decades of paper fraud meeting physical reality. The paper-silver market was always a lie. The contracts were never fully backed by metal. The prices were never determined by true supply and demand. The manipulation was never sustainable. The only question was when the lie would be exposed. That exposure is now underway. The 15% single-day withdrawal is not just a data point. It is the beginning of the revelation. It is the moment when the gap between paper and physical becomes visible to everyone. It is the blood that proves the patient is dying. The death of the paper-silver market is not a tragedy. It is a correction. The paper market distorted prices for decades, causing underinvestment in mining, misallocation of resources, and theft from producers and investors alike. The death of the paper market allows true prices to emerge. True prices will incentivize new supply. True prices will ration demand appropriately. True prices will create a healthy market where participants are rewarded rather than robbed. For those who hold physical silver, the blood in the vaults is your blood in the sense that you have been the victim of the manipulation. You have held metal that was artificially suppressed. You have endured years of watching your investment lag while paper assets soared. You have been mocked by mainstream experts who called your silver a pet rock. The blood in the vaults is justice. It is the manipulators bleeding out. It is the end of their power and the beginning of your reward. The blood in the vaults is also a warning. When systems fail, they fail chaotically. The transition from paper to physical price discovery will not be smooth. There will be volatility. There will be interventions. There will be desperate measures by desperate institutions. The blood will spill in many directions before the bleeding stops. Prepare for turbulence even as you celebrate the destination. 15% of the silver vanished from the COMEX vaults in 24 hours. The blood is visible. The patient is dying. The paper market is ending. The physical market is taking over. The price is going dramatically higher. The holders of physical metal will be rewarded. The holders of paper will be devastated. Choose your side wisely. This has been Silver Storm Daily. 15% of COMEX silver vanished in a single day. The vault drain is accelerating. The delivery failure is approaching. The paper market is dying. The physical market is ascending. Hold your silver. Buy more if you can. The blood in the vaults proves that everything we predicted is coming true. Like, subscribe, and share this video with everyone who needs to understand what the vault drain means for the silver market. The evidence is undeniable. The direction is clear. The opportunity is now. See you in the next report.